You've seen the headline before. Company files for bankruptcy. Stores closing nationwide. Hundreds laid off. And the explanation usually sounds simple. The company failed. But here's the harder question. What if it didn't fail? What if it was drained? Today we're talking about how private equity can extract billions from companies long before those companies collapse. Private equity firms like Bain Capital, KKR, Apollo Global Management raise massive pools of capital from pension funds, endowments, and wealthy investors. Then they buy companies, but here's the key. They usually don't buy them with cash alone. They use debt. This is called a leveraged buyout, an LBO. The firm puts up a portion of the purchase price. The rest is borrowed. And that debt, it doesn't stay with the private equity firm. It gets placed onto the company that was just acquired. The company now has to repay the loan that was used to buy itself. Once that debt is in place, everything changes. The company must generate enough cash flow to service the loans. So management cuts costs, layoffs, closed locations, reduced benefits, deferred maintenance, anything to increase short-term cash flow. And sometimes there's another step. It's called dividend recapitalization. The company borrows even more money, not to expand, not to innovate, but to pay a dividend directly to its new owners. Cash flows out, debt stays behind. If the company thrives, the private equity firm wins big. If the company struggles under the weight of debt and collapses, the firm may have already recouped most or even all of its initial investment. The downside falls on workers, creditors, and communities. This pattern has played out across retail chains, hospitals, nursing homes, and infrastructure assets. When economic conditions tighten, rising rates, competition, recessions, highly leveraged companies have very little margin for error. Bankruptcy follows, and the public story becomes market forces. But structurally, it wasn't just market forces, it was financial engineering. Now, to be precise, not every private equity deal is destructive. Some firms improve operations, some rescue struggling businesses, but the model incentivizes leverage and speed. Private equity funds typically operate on fixed time horizons. Performance is measured by internal rate of return. That rewards extracting value quickly. Debt magnifies returns when things go well, but leverage also magnifies fragility. Here's the biggest issue. When the essential institutions, hospitals, housing providers, long-term care facilities are treated primarily as financial vehicles, resilience declines. The gains are concentrated. The risks are dispersed. Workers absorb the shock. Communities absorb the shock. Patients absorb the shock. And because the mechanics are technical, covenants, recapitalizations, structured debt, it doesn't look dramatic. It looks like accounting. So the next time you see a company fail, ask a sharper question. Was it mismanaged? Was it engineered for extraction first, survival second? Because in modern finance, collapse isn't always incompetence. Sometimes it's embedded in the structure.